As of 11:55 a.m. Eastern Time, Plug Power, trading under the ticker PLUG, is at $2.8787. That's a drop of about 2.75% for the session, with the stock trading in a tight range between $2.85 and its opening price of $2.96, all on about 33 million shares of volume. Now, the immediate reaction might be to see this as just another day of volatility for a clean energy stock, but what's happening just under the surface is far more critical. The data shows that as of the most recent filings, the short interest on this stock is a staggering 34.8% of the entire float. This isn't just a popular stock, it's a battleground. Nearly 384 million shares are being held by traders who are betting heavily that this price is going to fall, and fall hard. That context changes the entire picture from a simple 2.7% dip into the latest move in a much larger conflict. The general belief about Plug Power is well established. This is the company that was supposed to power the new green economy. They are the ones putting hydrogen fuel cells into forklifts for giants like Amazon and Walmart. And they are the ones building the massive green hydrogen plants, like their facility in Georgia, to create the fuel of the future. The expectation is that as the world decarbonizes, Plug Power will be a primary beneficiary. This is the narrative that has drawn in a massive, loyal following of individual investors. But the reality is far more complicated and, frankly, far more dangerous. The reality is that this is a company with a well-documented history of significant cash burn, ongoing losses, and a persistent need to raise capital, which often leads to dilution. The expectation is a clean energy giant. The reality is a high-stakes financial war between a bull case built on future potential and a bear case built on present-day balance sheets. This conflict was perfectly illustrated in the stock's recent movement. Just this month, in early October, the stock hit a 52-week high of $4.58. This wasn't a random spike. It was fueled by a string of catalysts that sent short sellers running for cover. It started on October 3rd, when analysts at H.C. Wainwright reiterated their buy rating but dramatically increased their price target to $7, arguing that rising electricity prices are making green hydrogen a more viable competitor faster than expected. This was followed by news of Plug delivering its first 10-megawatt electrolyzer system to Gulp in Portugal, a major European project. Perhaps most importantly, the company itself guided that it expects to exit 2025, this very quarter, with positive gross margin run rates. For a company famous for its negative margins, this was a massive statement. The stock exploded, rallying over 160% in just 5 weeks. But as we see today, that optimism has faded, and the stock has pulled back significantly from that $4.58 high, settling back into this sub-$3 trench. The bulls who bought at $4 are now underwater, and the shorts who were squeezed are likely reloading their positions. This brings us to the core of the Plug Power story right now, the short interest. Let's be very clear about what these numbers mean. 34.8% of the float shorted is an extreme number. It signals a deep, fundamental disagreement in the market. The short thesis is straightforward. The company is burning cash unsustainably. Despite the positive guidance, bears simply do not believe Plug can achieve profitability before it runs out of options and is forced into more massive dilutive stock offerings, crushing the price. To them, the recent sustainable aviation fuel partnership is just another distraction from the core problem of liquidity. They are paying a high price for this bet. The cost to borrow Plug shares, the fee shorts must pay to hold their position, was last seen at over 15% annually. That is an expensive bet to maintain, meaning they need the stock to fall, and soon. For the retail investors who frequent forums on Reddit, this setup looks something else entirely. They see the massive short position, the high borrow fee, and they also look at data like the fails to deliver, which showed over $82 million in FTDs in a recent 3-month period. To them, this combination isn't a sign of fundamental weakness, but a sign of a coordinated predatory short attack and the perfect setup for a massive short squeeze. They believe the H.C. Wainwright target of $7 is real, and the 384 million shares shorted are trapped. What's your take on this short interest? Is it smart money seeing the cash burn, or a coordinated attempt to suppress a hydrogen leader? This is the central question. As an investor, you need to know how to navigate this. You can find short interest data published twice a month on NASDAQ and other financial sites. You can track the borrow fee on platforms like Interactive Brokers. A rising borrow fee alongside positive news can often be a precursor to a squeeze. But it's a dangerous game. Chasing a squeeze is not investing. It's high-stakes speculation. A company can remain heavily shorted for years if the bear thesis is correct. While retail investors are debating a squeeze, the smart money, the major institutions, are just as divided. Fillings from mid-year showed some major players were cutting bait. UBS Group, for instance, slashed its position by over 63%. But here is the critical countersignal. On October 17th, just a couple of weeks ago, BlackRock, the world's largest asset manager, filed an update showing it had increased its stake in Plug Power by 18%. BlackRock now holds over 98 million shares. This is not a small speculative bet. This is one of the largest financial institutions on the planet looking at the same cash burn, the same short interest, and the same $7 analyst target and deciding to buy more. This single move is a powerful, tangible piece of evidence for the bulls, running completely counter to the massive short position. Alongside Vanguard, these two giants are the largest holders, effectively providing a floor of stability against the extreme volatility. So, what does Plug Power actually do to inspire this level of devotion and hate? The company has effectively split into two parts. First is the legacy business, its GenDrive fuel cell systems. These are the engines that power material handling equipment, primarily forklifts, in warehouses and distribution centers. This is where Amazon and Walmart come in. It's a solid business, but it wasn't the high-growth story everyone wanted. The second, newer part of the company is the ecosystem play. This is where the real excitement and the real cash burn is. Plug is now trying to become a vertically integrated green hydrogen company. This includes manufacturing the electrolyzers that split water into hydrogen, the product sold to Gulp, and also building its own hydrogen production plants, like the one in Georgia, to create the fuel itself. The new partnership with Edgewood Renewables to make sustainable aviation fuel is an extension of this. They don't just want to sell the engines, they want to sell the fuel for the next century. This is the ambitious, world-changing vision that bulls are buying into, and it's the impossibly expensive, capital-intensive vision that bears are betting against. Looking forward, the path for Plug Power is one of extremes. The analyst consensus is a hold, with price targets ranging from a catastrophic $0.76 to an explosive $7.35. The mean target is around $2.58, which is actually below today's price. This tells you that Wall Street, on average, is skeptical. The future outlook really boils down to one thing. Can they execute on their promise of positive gross margins this quarter? If they report earnings in the coming weeks and show that they have indeed stopped losing on every sale, it would validate the bull thesis and could be a catastrophic blow to the short sellers. The combination of that news with a 34.8% short interest could ignite the squeeze investors have been waiting for. On the other hand, if they miss that guidance, if the cash burn continues at its historic rate, it will confirm the bear thesis. It will signal that more dilution is inevitable and the $7 price target will seem like a distant fantasy. The stock's future is binary, with very little middle ground. Comment below with what you believe Plug Power will be by the end of 2026. Are you in the $1 camp or the $10 camp? To summarize, the expectation for Plug Power is that it's a simple, long-term growth stock for the green hydrogen economy. The reality is that it is one of the most complex and contentious financial battlegrounds in the entire market. The stock isn't trading on its long-term potential right now. It's trading on a direct conflict between its massive cash burn and its massive 34.8% short interest. The story is no longer just about forklifts and hydrogen plants. It's about balance sheets, borrow fees, and sentiment. And in this chaotic environment, the most important piece of recent data